Welcome to my channel. I'm the covered call guy, and today we'll be watching a video from the YouTube channel The Plain Bagel. It's titled "Is AI in a Bubble?" So I haven't seen it yet. I'll watch the video and give it a pause and give my thoughts and opinions on it. Before we get started, legal disclaimer: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal. Always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. With that out the way, let's get started.
Hey everyone, it's Richard. You're watching The Plain Bagel. It's been about 3 years since ChatGPT first launched, and since that time, we've seen generative AI develop at a remarkable pace. AI images and videos have moved from horrific to near perfect, and large language models have gotten so good that companies have started laying off employees to replace certain workflows with chatbots. But while it certainly feels like we've entered this golden age of artificial intelligence, with some companies even teasing at the prospect of artificial general intelligence, or AI with human-like cognitive abilities, there's been this growing sense that maybe, just maybe, we're actually in a bubble. One Bank of America survey found that 54% of global fund managers believed that we were in a bubble. The International Monetary Fund and Bank of England have warned about the growing risk around soaring valuations. Michael Burry, the investor who famously shorted the housing market before the 2008 financial crisis, just this week announced a short position against key AI companies. And even Sam Altman, the CEO of OpenAI himself, has admitted that yeah, we're probably in a bubble. And many believe that we're in for a repeat of the dot-com crisis of 2000, given that we have investors.
I just want to pause there real quick because I see it a lot. The current market. There's in the current market is a direct repeat of the 1999 2000 dot-com bubble, right? Characterized by like crazy irrational hype, rampant speculations and valuations that are like just totally disconnected from reality. I just want to say, yes, you might have the term "it's different this time," and I do think that this comparison is fundamentally false, because the dot-com bubble was defined by an actual complete lack of earnings, right? The 2025 or the 2024 2025 AI boom is actually defined by record breaking tangible profits, right? The profitability in 2000 was like maybe 15%, right? Maybe less, maybe 10%, right? And only estimated like 10% of dot-com bubbles were actually profitable, right? Like the boom that was led by companies with no revenue was like financed by actual speculations of those IPOs, right? Where today the boom is more led by like cash generating assets, machines, right? And even the Fed chairman Jerome Powell, right? He came out and he stated, I think it was either last month or a few months ago, I think it was like October 2025 or September. He was talking about how today's companies actually have earnings. And if you go back to the 90s, like those were just ideas rather than actual companies. So, yeah, talking about the dot-com bubble, right? The Nasdaq was like 60 or 80 PE or something like that. While the Nasdaq 100 today is like 30, which is still high, but like it was like 3 times higher, or it was at least double to 3 times higher back in the 1990s. And although we are high, right? It is still anchored by like real earnings, right? The tech sectors accounts for like 40 to 50% of the S&P 500, and it contributes like 45% of its actual earnings.
Throwing money into a new, promising technological revolution, pushing valuations, namely the CAPE ratio, to levels not seen since the dot-com bubble, despite the space not, at the moment anyway, really making any money. OpenAI, who's behind ChatGPT and the video generating Sora platform, was recently valued at $500 billion despite seeing just over $10 billion in annual revenue and losing even more than that to its expenses. And then there's this monstrosity, which you might have seen circulated in videos like that from Hank Green, that demonstrates the incestuous financial relationships we have in the AI space.
Yeah, I do agree. It is getting ridiculous how they're. I mean, but at the same time, the counter argument to this is that that's how an actual economy works, right? When you are spending money to buy something from a business, you're exchanging that money goes to that business goes to exchange hands to another business, and it just goes in a circle. With this, yes, it is more of a closed end circle where it's not actually going back into the economy. Um, Open AI, yes, it does have some crazy uh, evaluations. I agree with that. But when you talk about Nvidia, right? Nvidia, like the skeptics who claim that Nvidia's valuation is hyped, they're ignoring their financial statements, right? For the fourth quarter of 2025, I think Nvidia reported like something like 40 billion, like an 80% increase year over year, right? So yes, it is driven by like AI data sensors, but it's still from the previous year, previous quarter, it was still like up to like 110% increase. So it's not speculation, right? They actually earned it. It's documented, right? It's historical revenue, and it's only gonna get bigger when um how they the US banned Nvidia from selling chips to China. So China now is gonna start building their own. So now it's just a whole race, whereas it's which one of them are going to win the AI race, and that is going to fuel money into it, which leads to better, more efficient AI and building and networking like that. That's the whole point of that, right? So it may be, for the most part, may be unprofitable now, but it's already starting to establish that it can be a profit generator, right? So um just the FYI, I think a lot of people kind of go a little too crazy talking about this, but um, I
With companies like Nvidia effectively giving money to companies so that they can buy their chips. Now that's a gross oversimplification, but you get the point. The optics aren't great. We're not really beating the bubble allegations. So what's going on? Are we truly in for a dot-com bubble 2.0? Well, to find this answer, we have to go to the source. It's almost as inconclusive as me. Joking aside, at the risk of throwing yet another video into the sea of content on the supposed AI bubble, I did want to address.
if everyone talks about how it's a bubble, then it's probably not a bubble, right? A bubble occurs when no one expects it, when no one is talking that it's, oh my God, it's a bubble. When everyone's saying, yo, get your money out, it's a bubble. That's when it's not a bubble, right? So a bubble occurs when it's least expected and no one is talking about it.
Situation, explain what's going on, why things appear to be frothy, but also to highlight the key differences between the current AI situation and the dot-com bubble of 2000 without falling to the sensationalization that often befalls these type of topics. And to be clear, this is not to discredit the bubble claims or people like Hank Green who are highlighting real issues in the space. It's just to give more details and context so we walk away with a better understanding of what exactly is going on. And to start off, it's probably worth highlighting the key players in the AI space. The first group are the AI chip companies, the businesses who sell the hardware needed to run these AI models. This includes AMD and of course, Nvidia, who's absolutely dominated and been incredibly profitable with this AI build out, which has helped skyrocket their market capitalization to a record $5 trillion, making it the largest publicly traded stock. Then there's the infrastructure providers, the data centers, cloud providers, whatever you want to call them. The businesses who buy or rent these chips, build data centers to plug them into, supply electricity, and then ultimately sell the compute of these data centers to AI companies themselves. These businesses include the likes of Amazon, Microsoft, Oracle, and a number of other companies with at times mixed financials, but a number of key players here do have very strong balance sheets. Then there's the AI companies themselves who buy the compute from these data centers to build, train, and ultimately run their AI models. And here we have a whole mix of companies from a financial standpoint. On the one end of the spectrum, you have firms like Meta, which is a massive company with very good financials that's trying to build its own AI models. There are then hordes of AI startups, with there being over 1,300 companies with valuations over $100 million, and nearly 500 AI unicorns, or companies with valuations of over $1 billion, with notable examples including Anthropic and Elon Musk's xAI. And then of course we have the leader of the space, OpenAI themselves, by far the most successful company in artificial intelligence, and yet one of the biggest money furnaces, with a company targeting revenues of $13 billion and losses of $8.5 billion for 2025. And the company's own estimates, according to one source, see it burning through $115 billion through 2029, with the company even losing money on their highest $200 a month subscription, given that people are using the service more than expected. Now, because OpenAI is a private company, meaning they aren't a publicly traded stock, we have very limited insight into their financial health, but definitely a questionable business model. Most users are melting OpenAI's GPUs as free subscribers after all. Yet
Yeah, from what I'm hearing, it does sound like AI is getting worse, and I've been reading up on Reddit that the users are saying Chat GPT 5 is much more worse, is far worse than Chat GPT 4 or 4 point whatever meaning they use. I'm not sure, but there on Reddit there's a lot of angry redditors saying uh Chat GPT 5 is far worse with much more issues. It's like it's been nerfed completely. So yeah, yeah, for sure. I see the frustration online. So OpenAI does have to fix and correct um their AI, or obviously they're gonna keep losing money.
this hasn't stopped the space from building out aggressively. OpenAI alone has made plans to build out up to an additional 26 gigawatts in data center capacity. And to date, the company has committed to around $1.5 trillion in AI deals. This includes its involvement in Project Stargate, a $500 billion initiative to build out data centers in the US, a $300 billion deal with Oracle to purchase compute power over roughly 5 years, and deals to buy chips from Nvidia and AMD, which the Financial Times forecasts could cost $500 and $300 billion respectively, with these just being some of the many arrangements OpenAI has entered. Now, numbers like these can easily lose their meaning once they get high enough, but it's important to put them into context here. A gigawatt of power, for example, roughly equates the output of a single nuclear power plant, and would provide enough electricity to power just shy of 900,000 households, according to the Carbon Collective. OpenAI is planning to consume the power of 26 of these simply to run its software. And that's just OpenAI's own investments. McKinsey has
Yeah, that's actually insane. Like they're saying the massive capital expenditure, which is capex, right, on data centers is projected to be at least 300 billion plus. Um, that is actually insane. I believe that analogy fails on two counts though, because it misrepresents the 1990s bus, and it misinterprets strategic um necessity of today's investment, today's like world, right? The 1990s, right, the telecom build out was driven by like fraud, right? Remember WorldCon? If anybody remember WorldCons, they're like $15 billion fraud, and like all of their fake vendors and finance, they're financed to inflate revenue. Um, Today is more of the capital is pushing the fiber onto the market, right? So it's real, it's tangible. Demand for AI compute is actually pulling capital, right? So demand for accelerated compute for AI continues to outstrip the supply. The capex is not the cost, is in the bubble sense, is more of like the inventory for the highest demand, right? Highest margin products these companies sells. So it's more of we're not building out infrastructure fast enough to keep up with AI, rather than AI is outgrowing and we can't um use it properly. It's more we actually it's growing so fast that we're not actually building up the capacity to handle it. So once we match that, then we will see AI actually really taking on its true form. So
estimates that data centers themselves and the infrastructure for these companies will need to spend nearly $7 trillion in capital expenditures to meet the demand for AI and traditional IT applications. And while this is a global figure over a 5-year period, to put it into perspective, America's total capital expenditures for 2024 was around $8.3 trillion across all industries. So in effect, we're seeing the AI industry spend a fifth of America's total capital expenditures just in one industry. Needless to say, it's a lot, especially for companies that are losing billions of dollars annually. And so because these companies are planning to spend well beyond their current means, they've naturally needed to call on investors to help fill the gap. And so far, they've risen to the challenge. Venture capitalists have poured a record of nearly $200 billion into AI startups so far this year alone, with over half of total VC investments year to date going into this space. But the cost to build only expected to increase. And that's where this concerning kind of circular chart comes into play. You see, the diagram lays out a number of key AI financing deals, and it demonstrates that many are a bit circular in nature. NVIDIA, for example, has pledged to invest $100 billion in OpenAI in return for the company buying its own chips. NVIDIA also invested in CoreWeave, an AI data center that sells compute to OpenAI, and agreed to backstop the company's services if it failed to find customers. AMD supplied OpenAI with warrants for its shares in return for OpenAI buying its AMD chips, with that announcement alone sending AMD's stock higher, which actually helps to pay OpenAI for the whole arrangement. And OpenAI announced a deal to pay $300 billion to Oracle for data center capacity, who naturally is going to turn around and buy chips from NVIDIA for those data centers, who is invested in OpenAI. So you can see it kind of leads to this circle, which has drawn some concerns. And even since this chart has been published, we've seen even further deals announced, including OpenAI's $250 billion deal with Microsoft's Azure, with Microsoft being a major shareholder in OpenAI, and the company's $38 billion deal with Amazon's AWS. And these are just some examples. OpenAI isn't even the only company involved in these sort of circular deals. But at the center of a lot of these deals has been NVIDIA, the one who so far has profited the most from the AI gold rush. It seems like they're investing that dragon's hoard in any AI company that pops its head up, with there being recent announcements around investments in Intel, Nscale, Wave, and...
So are they, I'm not, is he making a point where there's no return on investment or productivity gain or something? Because I'm pretty sure that's wrong, right? If he's claiming that, then I'm pretty sure it's very misleading there. That is just how a globalized chain works. You kind of need each other for one to work. That's just how it works. You're feeding money to have parts and services, right? OpenAI can't do it all. It just can't. So I don't understand what the issue. There is some concern. I can understand the concern, but it's a globalized supply chain. You kind of need other competitors to fill some of the spots, right? Competitors or other IT companies too, to kind of help fill the gap. So not really too concerning.
Even Nokia, which I'm guessing they're looking to make their chips indestructible, which actually could be a smart move. But it's led to concerns that the so-called pick and shovel seller is actually just paying gold miners to buy its picks and shovels and effectively propping up the space. Now, to be clear, the arrows in this chart aren't dollar for dollar arrangements, so the circle analogy isn't a perfect one. But it could mean that NVIDIA is overstating its profits. After all, if you're investing in your customers to give them the cash they need to buy your chips, then you're effectively selling your products at a discount without recognizing the hit to your profit margin, since investments aren't factored into the margin calculation. And some have pointed out that this type of vendor financing became very popular with companies like Nortel towards the end of the dot-com bubble. Not to mention that with us seeing AI companies starting to borrow billions of dollars to buy these chips and even putting their current chips up for collateral for some of these loans, it's led to, again, this concern of this propping up of demand beyond what's sustainable. And amid this massive build out and the deals being made in the space, There's a question about whether there will actually be enough demand from end users to justify all these investments. Bain & Company, for example, estimates that AI companies will need $2 trillion in annual revenue by 2030 to be profitable, which, as noted by the Wall Street Journal, is more than the 2024 revenue of Microsoft, Meta, Alphabet, Amazon, Apple, and Nvidia combined, and 5 times more than the entire software as a service market. And there just doesn't seem to be a path towards that type of profitability. Yes, 88% of companies are using AI in their workflows to some capacity. And OpenAI itself has seen remarkable user growth. You might remember that ChatGPT broke records in terms of being the fastest growing app, and the company now boasts 800 million weekly active users. But only up to 6% of these users are estimated to be paying for this service. And the majority of companies using AI, around 61% according to McKinsey, currently don't see an enterprise impact on earnings before interest and taxes. And Citigroup earlier this year estimated that AI revenue would only reach $43 billion in 2025 and $780 billion by 2030, which still represents pretty remarkable growth at 80% a year. But it's less than half of what Bain estimated would be needed for the industry to break even. And that's all assuming the AI companies are.
Again, I think AI don't have to worry about breaking even because this is more of a transformative technology. So, right, it needs to be adopted first. It needs to be scaled out, right? That takes a lot of time. It needs to be implemented, right? And across all industries and services. People have to actually start you have to start teaching it in school, so then the newer generations actually accommodates to it, right? So forget about the older folks that they're eventually gonna have to be excluded, right? So it's gonna come to a point in maybe 2030, like he said in this video, or 2035, within 5-10 years, that you will need AI no matter what. You're gonna go to the bank and you're gonna deal with some sort of AI. You're gonna go to online to pay your bills, credit card company, you're gonna have to deal with some AI, right? So it's gonna be there across the board, and it's just a matter of adoption, scaling it, right? Mass scale adoptions, and it already has documented return on investment. So the bubble thesis right there, I truly believe it's flawed, right? Productivity gain is gonna only increase as mass adoptions take hold, especially in countries that are able to build out new infrastructure instead of having to keep old infrastructure like the United States and other like Europe. Whereas South America, Africa, China's already doing this. The SEA, the Southeast Asian countries are that don't have the infrastructure, and they can build new infrastructure. They can adopt it much more quickly and implement AI on a scale that the United States may not be able to. So it's just a matter of building out these infrastructures and scaling it, and then training your people to adopt it, your companies to adopt it.
Are able to deliver on what they're promising. There's also the question of the bottlenecks we're seeing form in the space, with the key one being electricity. Building out grid infrastructure takes years of planning and development, and that's assuming you get through all the regulatory hurdles of bringing online more fossil fuels.
I was just about to say regulatory, but he mentioned it, right? So electricity part is 100% regulatory. Again, that can be done with one administration in the United States, right? You can literally build out one or two, three modern nuclear power plants to sustain this, or someone like Elon Musk gets the chains off his hands, and no regulatory holdback, and depending on how many solar or whatever he builds, right, to all these gigawatts. So all of that can be signed away and done in a stroke of a pen. Nothing is holding that back. So that is really just ourselves holding ourselves back.
Fuel or even renewable plants, which don't always provide the consistent electricity needed for data centers. And while nuclear power plants have been a popular choice for data center powering, in the US, the NRC application review process can take 5 years alone to complete.
Yep, just as I said, nuclear plants again up to 5 years to complete, but that really depends on all this holdback, which some of it is good. Of course, right. You don't want a nuclear spillage, or a nuclear fallout like what happened in Japan, because what happened with Japan is that their nuclear reactor, it turns out that there was shortcuts made and it didn't last as long, and the procedures to stop a spillage did not work because of the um, shortcuts, and they were pretty much um, uh, someone got a cut under the table. So of course there is some regulatory stuff that we should have, and maybe cut it from 5 years to 2 years, or 2.5 years in half, right? That's still good.
with construction often taking another 5 or more years, according to the US EIA's own website, which might be longer than these companies are able to woo investors. It's even led to some companies like XAI skirting regulations to set up on-site generators to try and meet their electricity demand. Then there's a consideration around the lifetime of the data center hardware itself. Over the last few years, large tech firms have been expanding the assumed lifetime of its servers, spreading out their accounting costs over a 4 to 6 year period, whereas some have argued that with NVIDIA releasing updated, faster chips every year, the amount of time before these chips have to be replaced is actually much shorter, which means that many of these companies are going to run into higher replacement costs than they're disclosing to investors. And when you throw in the sheer scale and concentration of the AI industry, with 35 to 36 companies accounting for 99% of all AI token spending, 2 companies buying nearly 40% of NVIDIA's chips, and 10 companies, most of which are involved with AI, accounting for 40% of the S&P 500, the failure of any one of these companies could lead to fairly big shockwaves, not just in the space, but even the markets as a whole. Not to mention the real estate, utility companies, and financing firms all involved in the industry. And OpenAI alone has a lot of the market's weight seemingly on its shoulders at the moment. OpenAI's deal announcements have added hundreds of billions of dollars to the market value of companies like Broadcom, Nvidia, and AMD. If we see a pullback in that company, it's going to hurt valuations for many of these businesses, especially when you consider how expensive many of these companies.
Yeah, I mean, I guess that's true in some point. Like, every single company right now, Nvidia has like a market share of like 90 or 95%, so they're choking out the market. So yes, there is some rational fear to that. The only way to make it, I guess, safer is to uh have other companies compete with Nvidia and have a more diversified supply chain. But if every company kind of needs Nvidia, then I mean, Nvidia is going to do well, and if Nvidia does well, everyone else does well. So, can only pray that we can have other chip companies catch up on their part and compete with Nvidia. But so far, Nvidia's chips are just pretty much unmatched.
Have become, with investors pricing these stocks for perfection, leaving very little room for disappointing results. So yeah, it's easy to see where the comparison with the dot-com bubble comes from. In fact, if you lump in software, computers, and peripheral equipment, and other information processing equipment, the current private domestic investment in IT as a percentage of GDP is back where it was during the dot-com bubble. And what's important is that you can still see losses in the market even if the technology proves to be promising. The internet did, of course, revolutionize our lives, but also led to an 80% collapse of the NASDAQ over 2.5 years, as thousands of shaky dot-com startups convinced investors that they were on the frontier of a new, highly profitable business that ultimately would only actually benefit a few players. So it brings us back to the question, are we truly in for a dot-com 2.0? Well, while there are
I'm gonna say no, because it is different this time. There is a lot of use for AI, and AI is only getting better. It's only getting more advanced. It's only getting more intertwined with daily life, especially for, I guess, anybody 40 and under, maybe even 45 and under. Especially, and then of course by the time 2030, 2035, 2040 comes around, right? In a short 10, 15 years, AI is gonna be 95% of lives, right? I'm almost certain of that, right? It's gonna be in healthcare. It's probably already in healthcare, but what I mean by that is like it's gonna do like 90% of the jobs in healthcare, right? If it advanced the way it's advancing. You already see the robo taxis, right? That's AI, right? So give it another 10 years and robo taxis is going to be like the norm, right? So think about the deliveries for the drones Amazon's using. That's AI. If you think about it, in 10 years, those AI drones are going to get even far better, right? So it's going to be so interconnected that I don't think it's a bubble. Like if it pops, then where does AI go? Like AI is so used right now. Now imagine 10, 15 years in the future. Like they're already talking about having an AI real estate agent. Like at that point, like you don't even need to see a real life person. You can just talk to an AI a realtor, and basically like buy and sell houses that way. Like think about it. 10, 15 years from now, how much more would have AI replaced, right? I mean, if it's a bubble, then that's like saying like AI has no functions compared to the 1999 to 2000 bubble. I truly think it's different. I really believe it's different. There's actual use for AI.
Of course, parallels with a new technology, investor enthusiasm, and concerns that things are overvalued. There are also a number of key differences that make for a very different setup here. For one, there's valuations. Yes, the CAPE ratio, a commonly cited measure of stock market valuations, is fast approaching the highs we saw during the dot-com bubble, with the cyclically adjusted PE ratio measuring the difference between a stock's price and how much money the company is actually earning. So how much investors are willing to pay per dollar of earnings per share effectively. However, it's important to note that with the CAPE ratio specifically, it does include smoothing, meaning that the earnings put less weight on any sort of surge in profits we see. If you use a more basic trailing PE ratio for the S&P 500, which only considers earnings over the last 12 months, you can see that the current ratio sits at roughly 30 times, which yes, is still high on a historical basis, but it compares to the dot-com bubble where we reached a high of 46 times. So we aren't yet at the same extended level of valuation. Which brings us to the second point, which is that compared to the dot-com bubble, there's actually strong financials and earnings to back up many of these valuations. Morgan Stanley, for example, has highlighted that S&P 500 companies are generating 3 times the cash flow as a share of their valuations versus what they were generating leading up to 2000. And on a relative basis, there are nearly half as many unprofitable technology companies when compared to 2000, when 36% of tech companies were losing money. Now, this doesn't account for private companies like OpenAI or Anthropic, which are highly unprofitable, but these startups have the backing of companies that are highly profitable and are generally viewed as financial strongholds. Many of these big tech companies have very little debt and hordes of cash on hand that they've accumulated over the decade. So there is some evidence that leverage is slowly creeping up in the space, which could lead to some problems if that continues. Currently, a lot of the spending has been backed by cash on hand or cash flows from these large companies, which does limit the fallout if we see one of these investments not ultimately pan out. I also want to highlight a few considerations when it comes to the circular dealings in the AI space. And this is not to really defend these companies or argue that there's not something, kind of prop uppy going on here. But when it comes to NVIDIA specifically, it kind of makes sense that this is the approach they're taking. Companies like NVIDIA are making so much money that it can be difficult to find places to park that capital without dragging down the company's performance. So it kind of makes sense that NVIDIA would invest in the ecosystem that will ultimately benefit its future demand. If the companies it invests in.
So that was literally what I was saying in the beginning, that Nvidia, it's just an economy, right? They're exchanging cash and saying, here, go ahead and build whatever you can to make your company more bigger and expand, because when you expand, you're gonna help me expand by buying my chips and my products and my services. So it's not like it's just giving you money and you're doing absolutely nothing with it and just burning it. So I think a lot of people misunderstand that chart, and it's just a fear rationale, fear mongering spreading. If you look deeper into it, it's just that's how an economy works, right? You have to use that money, even if it's your competitors, right? If you're building like competitors, it doesn't mean you're dragging yourself down, right? Nvidia is so big that they want to build their competitors. That way, if anything, Nvidia doesn't face a breakup, right? So It's good that the competitors build them up. They still depend on Nvidia.
Are able to succeed with that investment, then that means that they are effectively incubating a future customer. It's also not where most of their cash flows are coming from. The company over the last 12 months made $77 billion in operating cash flow and paid out $24 billion in investing cash flow, of which a fraction would be this sort of vendor financing. And while there are larger financing deals set up with OpenAI for the future, for example, it's important to note that many of these arrangements are performance-based, which makes sense given that there is this perception that OpenAI may be faking it till it makes it, that it's kind of talking out of its ass with, with these large deals that it's making, given again just the scale of these deals relative to its current revenues. But the point is, NVIDIA isn't just writing blank checks, with, according to Bank of America, vendor financing only representing a fraction of current AI spending. It's also worth noting that bubbles don't tend to just pop on their own, and part of the reason we saw the dot-com bubble deflate was actually fairly rampant fraud in the space. Many large companies were discovered to have been cooking their books to meet higher and higher investor.
Literally what I was talking about in the beginning, right? The dot-com bubble was speculation and fraud. There was no revenue. It was all fake. Unless you guys think, OpenAI is fraud, Nvidia is a fraud, Google is a fraud, Microsoft is a fraud, right? If you think that is they're fraudulent companies, then yeah, sure. Then it's in a bubble. But they documented profits. So guys, what do you think? I don't think we're in a bubble. I think AI is just starting to begin its run, and it has so much more room to grow.
Expectations. And well, yes, fraud is certainly possible today, but we have seen reporting standards improve since the 2000 dot-com bubble because of these crises. We're also in a very different economic environment, for better or for worse, mind you, with rising interest rates often being cited as a factor that killed the dot-com bubble, whereas currently we have the Federal Reserve seemingly putting rates on a downwards trajectory. And with all this, it's important to acknowledge that we could very well see OpenAI's profits scale from here. Again, as a private company, we don't get much of an insight into the firm's financials. But with the company launching new services and many businesses looking to lay off employees to integrate more AI into their workflows, there is a chance the company is able to build its revenue. In fact,
So just like I was saying, companies are actually implementing AI. Like, I've made many videos on this and I've posted about this, that there's so much layoffs right now that a lot of jobs are being replaced by AI. So it's not just a fad, it's not fraud. You're actually seeing it in real time. Companies or using it, right? It's a transformative product. AI needs to be adopted, and companies right now are adopting it. We are seeing this in real time.
just as I was finishing up this video, it came out that Sam Altman expects the company to reach $20 billion in run rate revenue for 2025 and hundreds of billions by 2030, albeit they're still expected to be unprofitable in the near term. Now, I don't know if that's how things are going to play out, but companies who invest in firms like OpenAI do get more insight than we have from the outside. And yes, companies make bad investments sometimes. We aren't today living in the metaverse that Mark Zuckerberg desperately hoped we would be. But assuming that all these players are being perfectly irrational is just as dangerous as assuming that they're all being perfectly rational. Now, with all that being said, I do think there's a bubble of some sort. To be clear, this is not to downplay the very lofty valuations we have, the risk of a correction here. It's just to try and distinguish between a crisis and market.
Plain Bagel, man, but the AI bubble, that the whole premise is a narrative of speculation that ignores actual data, right? The dot-com bubble, it burst because it was built on hope and hype. It lacked profitability. It lacked real infrastructure. There was no widespread adoption, right? Right now we are seeing actual profits. Infrastructure is being built out, and right now it for the most part businesses are trying to implement the widespread adoption via the layoffs, not needing actual physical people anymore, right? So the AI transformation is built on precise opposite of the dot-com bubble. It's funded by profits, from cash-rich companies, as stated in your video, Mr. Bagel. It's grounded in real record-breaking quarterly earnings from core infrastructures. It is proven by tangible mass-scale adoption, with like 90% of these organizations, of not 90% of almost all business using AI in some form. It is validated by documented multi-hundred-billion-dollar companies, and we're seeing actual returns. Now, do we need to accelerate the foundation and the building blocks? Yes, of course. But once we do, you would see that massive scale up, going up even more for AI. So I don't think it's a bubble. I think it's a new construction of a new economic engine that is gonna be solidified, and we won't be able to say no to it.
Markets being disappointed with how certain investments play out. It is true that with high valuations, there's little room for error, and that leads to lower expected returns for investors. It's also true that the current investment activity is just blatantly unsustainable when you consider all the AI activity going on. We're also seeing many big tech companies lay off employees, which some are pointing to as evidence that capital spending and slowing economic performance are impacting operations. And we've seen signs of strain on market liquidity, which just means that investors might be less willing to lend that money to these AI startups in the future. It is also likely that we'll see a consolidation of the space similar to what we saw with the dot-com bubble. The truth is, we just don't have enough demand for 500 AI unicorns. And in fact, there's a lot of good research that highlights that.
Okay, I agree with that part, right? We don't need like 500 BS AI startup companies that have actual no, that has actual, that has no actual use and function in daily life or just life in general, right? We do see a lot of these uh California startups that are just pretty much BS. Like there was one that was I think there was AI about like reading people's horoscope or something like that. Like that to me was like, oh man, this is like some straight up cooking the books type of startup. So yes, I agree with Mr. Bagel here on that. Um but for the most part, I don't agree with how he's comparing it with the .com, because that the .com comparison fails on the most important metric, which is profitability. Yes, OpenAI is not profitable, and they mentioned it. They said it. Even by 2030, they won't be profitable. But if they're scaling and they're actually building up a user base, putting out functional new uh, like apps and programs to use, and people are actually getting and buying it, I think they can build a foundation there. Again, we won't really see this until mass infrastructure is built. Then that would follow by mass scale adoption.
Technological revolutions have historically been bad investments on average, given that they tend to lead to this boom and bust in market prices, and the attrition experienced by all the companies throwing their names in the hat has a negative impact on market returns, even if the technology goes on to be successfully adopted. And as companies like Netscape perfectly highlighted during the dot-com bubble, being the market leader during the technology's rollout doesn't guarantee that leadership spot in the future. And if you've never heard of Netscape before, kind of perfectly illustrates the point. But the point is, we just don't know yet.
I don't think anybody in that time even heard of Netscape. I mean, I've heard of it just because I'm very, I consider myself very tech savvy, but I don't think that proves the point at all.
AI is a new technology that could prove very.
I have to mention it's like mentioning VHS to like a 2020s kid, like, or like a kid born in 2010 or something. It's like, you know what a VHS is, or you know what those projector is that you used in school? Like, of course not, right? Like, come on.
Very promising and could lead to a lot of profits for these companies. Or demand just might never meet the high expectations that companies like OpenAI ultimately have. We could be in for a Metaverse 2.0. I would think this is probably a little more promising than that, but you get my point. Not to mention that at any point we could have a geopolitical event, a headline, a new development that completely changes what we were expecting to happen. And even if we are ultimately in a bubble, timing such a thing is near impossible. Alan Greenspan, for example, the federal chair at the time, called out the irrational exuberance of dot-com companies back in December of 1996, over 3 years before the bubble would ultimately collapse. And with companies like Meta viewing the risk of underinvesting as higher than the risk of overinvesting, these rallies can ultimately last as long as investors are willing to pile money into the space. Yes, at some point, these companies will have to transition from surviving on investor funds to earning customer revenues to fund their operations. But how long of a timeline we face until that has to happen remains to be seen. So hopefully you found this video helpful. As always, it's important to take a balanced view. There's just a flurry of variables that make it impossible to predict how things are going to play out. So while you certainly don't want to get caught up in the AI hype and, throwing all your money in Nvidia because you have ChatGPT making Studio Ghibli versions of yourself, it's worth hearing all the arguments. Thanks for watching. If you like this video, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously.
Yeah, I mean, on some points I do agree. On some points where he's comparing it too much to the 2000 speculations, where there was no profits and no infrastructure, like 2025, and no adoption. I don't know. I, I would say like upwards of 90% of like medium-sized and larger businesses like use AI in some form or the other, right? That the adoption is going to be far more reaching in then like 2 years and 5 years. AI is not going anywhere. It's just a matter of can the United States build out the infrastructure and the electricity capacity to actually support AI. So that's gonna be the main factors. Now, is it a bubble? Yes, if we cannot build the infrastructure out and like the data centers, electricity, like the foundation, then yeah, I would say it's probably gonna be a bubble because then now we're capped off and we're spending too much money. But other than that, no, I don't think so. I think AI has much more room to run. It's gonna be a like $5-10 trillion in worldwide in like the next five maybe less, maybe not even 10 years, maybe about 5-7 years. Is going to be at least $5-10 trillion in my opinion. um Once you have these companies start actually scaling and having other countries pretty much adopt it and use their services, you're going to see it grow so quick and so fast. So I don't think it's comparable to the dot-com bubble that keeps getting mentioned here. But great video from Mr. Plain Bagel. I really enjoyed it. I always enjoy watching his videos, but he opens me to new ideas. But I do think that some of his points is very questionable because it just relates to like that one focus of dot-com bubble. Well, anyways, let me know what you guys think about it. If you think AI is a bubble, please subscribe, comment, and like. Let me know. Appreciate it, guys. Thank you.